The great thing about MMT is that the essentials of it are very simple. And even when we're dealing with complicated issues like how the banking system is organised at the moment, really we want to simplify it. And it is possible to simplify these things so that anyone can understand. And the complexity we have at the moment is completely unnecessary.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to episode 13 of the Modern Monetary Theory Podcast. You just heard my guest this week, MMT economist and author Dr. Stephen Hale, laying out our mission for this episode, to boldly go where several people have gone before, into the intricacies of the banking system, but this time without coming back covered in bullshit. Hopefully, you've heard enough of our earlier episodes, or maybe you know intuitively that modern money is a creature of the state and a creature of law, rather than a naturally pre-existing thing dug out of the earth. The UK government is the monopoly issuer of the pound, the US government is the monopoly issuer of their dollar, and the Japanese government is the monopoly issuer of Japanese yen. If anyone else tries to create pounds, dollars, or yen, we call that counterfeiting, and it attracts a heavy penalty. So to the government, the currency system is like a big scoreboard. The government adds points or pounds when it spends, and then it subtracts points or pounds when it taxes. Governments like the UK, the US, Canada, Australia, Japan can no more run out of money than a scoreboard can run out of points. As MMT founder Warren Mosler says, the US government neither has nor doesn't have any dollars. It's a scorekeeper for the dollar. So, talk of running out of currency by the issuer of that currency is just completely the wrong framework for talking about national accounting in a modern money system. But wait, I hear you say. My friend who knows things told me that evil banks create all the money. And then they lend it to the evil government at interest. And that's why we're all in debt peonage to the 1%. No, my learned friend. Pounds are a government monopoly. So what are the banks doing? They've got something to do with money, right? Yes, of course they do. And that's what this episode's all about. What happens to the scoreboards at your bank and at my bank and at the central bank all day long as we transact in pounds in the banking system? If this raises any questions for you, please get in touch on Twitter at MMT Podcast. Or there's a list of other ways to get in touch at the end of the show. We try to answer what we can and direct you to other people when we can't. Thanks for your patience, support, and the time you put into understanding MMT. Speaking of which, I can announce some exciting MMT events. We're lucky to have two of the principal architects of MMT visiting the UK soon. Professor Bill Mitchell and the man himself, Warren Mosler, are giving several talks. They're in Edinburgh on May the 8th and Glasgow on May the 9th, 2019. The easiest way to get tickets is to find our friends MMT Scotland on Twitter. Their Twitter handle is simply @MMT Scotland, and their pinned post gives all the details. Also on May the 11th, 2019, the Gower Initiative for Modern Money Studies is hosting a seminar with Bill Mitchell and Warren Mosler in Birmingham. Yeah, we have a Birmingham in England, Americans. It's a bit rainier than yours, but we do okay. Anyway, best way to get tickets for that is to find the Gower Initiative on Twitter. Their handle is @Gower Initiative, and all the details are in their pinned post. Both MMT Scotland and the Gower Initiative are on Facebook too. Okay, time to learn some modern money with Dr. Stephen Hale. Welcome back to the podcast, Stephen Hale. It's great to have you. How are you?
I'm fine, thanks, Christian, and thanks for having me on again.
Absolute pleasure. The reason I wanted to get you on is you trained people at the Bank of England way back when.
Well, I didn't train them when they were at the Bank of England. I trained staff from the Bank of England. Yes, they were on courses that I taught. Yeah, and not just the Bank of England either. There were, in those days, there were probably 600 international banking institutions in London. I don't know how many there are now, maybe the same number still. And at one time or another, I probably taught people from most of them and all the major UK banks as they were in those days. Things have changed a bit since then, though. That stopped in the 1990s when I came over here.
Yeah. So I wanted to try and take the listener on a guided tour of how commercial banks transact with each other and how and when the central bank gets involved.
We probably should keep it simple because you can make that very complicated. The payment system, well, wherever you look now, but including in the UK these days, is quite complicated. There are various elements to it, but the nature of transactions taking place between banks and the central bank, the Bank of England, in the UK is relatively simple, as it always was.
Here's the way in that I've wanted to take, but we can go your way if you think it's too complicated. I'll just talk about a real world example that we can all relate to. And well, I'll use the first person. So I'll say, look, I have an account at NatWest Bank. Now, NatWest as an institution, they have an account at our central bank, the Bank of England.
They do?
But I don't.
That's right. Their account is called an operational balance. Yes, you don't have an account there. No.
Yeah, exactly.
Absolutely.
Right.
You might have done if you'd been a Bank of England employee until 3 or 4 years ago. They used to run a small retail banking division just for their staff, which friends of mine who worked there, they used to show off. They had Bank of England checkbooks and all the rest of it, but they stopped doing that 3 or 4 years ago. So literally nobody has a retail banking account at the Bank of England anymore.
Right. That would have been quite good because they could have whipped out their checkbook and go, yeah, look, I'll pay for the NHS. I got the checkbook right here.
Yeah, no, I'm not going to say anything. My friends might be listening. I'm not going to say anything about them and spending. Go on.
Okay. So NatWest as an institution, they have an account at the central bank, and the way I've been reading it, I've taught myself to call that a reserve account. But you've called it something else. Can you say that again?
Well, it is a reserve account, and that's a good term to use. But in different countries, they have different names. So we call them exchange settlement accounts in Australia. They're called federal funds in the US. They're called operational balances, or at least they used to be called that. I think they still are in the UK. But reserve account is fine. Cool. People do sometimes get a little bit confused over that word reserves, because the word reserves is used in the context of banks to stand for two completely different things. But maybe if it's appropriate, we'll come back to that later. But yeah, sure, call them a reserve account. Absolutely. That's the electronic cash that the banks themselves, the private banks, have at the central bank.
Great. All right. Now, let's say NatWest's reserve account balance is probably a few £billion, something like that, and it represents the deposits that NatWest has, including mine, as a whole.
No.
Okay.
That's not really right. They traditionally had very low levels of operational balances because they only need sufficient reserves at the Bank of England in order to deal with any likely interbank transactions that might take place day to day. They have far more in those accounts at the Bank of England than they used to do, because you've had years of quantitative easing in the UK, which have basically created a lot of excess reserves as far as the banks are concerned. So they've got more cash than they otherwise would have chosen to hold in the past.
Okay, quantitative easing is where I want to end up ultimately, so we'll definitely get to that.
Normally, they don't hold very much in the way of reserves at the central bank because it's not profitable for them to hold those reserves, and those reserves are only there really in order to deal with net flows of funds from bank to bank.
Got it.
And the banks borrow from and lend to each other excess reserves over time anyway, so they don't need to hold very high levels of reserves. And in the UK, there is no minimum reserve requirement. That's the same in Australia. In the US, there is a minimum reserve requirement. It's not particularly important, but it does explain why in some countries, historically, banks have held higher levels of reserves at the central bank than in others.
Got it. Okay. I mean, if you had to guess, and this might be a completely unanswerable question, but if you had to guess, what would NatWest's reserve balance be in the order of?
I have no idea now,
right.
because of quantitative easing.
Got it. What would it be in ordinary times?
In ordinary times, which in the UK is a long time ago now, but it might have been 1% of their deposits.
Got it. Right.
Something like that, a very small amount, because it's not profitable. The rate of interest that the central bank pays on bank reserves is below a commercial rate, so it's not a profitable asset to hold. Okay.
All right. So we've established that central bank reserve account balances, and they're sometimes called settlement balances as well, and that's because banks use them to settle with each other, and it's not our money.
Yeah, well, what they're there for the banks to buy new physical currency from the central bank. So how do the banks get the notes that you take out of your out of an ATM? They buy those with their exchange settlement reserves. They're there to facilitate interbank transactions. So when there is a net flow of funds from Bank A to Bank B, then there'll be a transfer from the exchange settlement reserves of Bank A to Bank B at the central bank. And they're there to facilitate transactions between the private sector and the central government. So if we pay our taxes, then actually our banks are paying our taxes using their reserves at the central bank. And also they're there to facilitate transactions between the private banks and the central bank itself. And the central bank in normal times has the responsibility of making sure that there's the right amount of cash, the right amount of liquidity provided to the private banks to hold the official interest rate at the level that the central bank has targeted.
And when you say liquidity, that is to the layperson. Yeah, that's cash. Like, so, I mean, I've heard Warren Mosler, MMT father, saying banks have infinite liquidity. You know, like the ability for a bank to lend is not constrained by deposits. By deposits, and also it's not constrained by reserves.
Yeah, absolutely. Banks never turn down an opportunity to make a profitable loan to a creditworthy customer because they are short of exchange settlement reserves. The bank will lend now, and if a bank lends to you, then typically, normally, what will happen is that at the same moment that you sign an agreement to borrow from the bank, so that there is now that's now a new asset as far as the bank is concerned. It's a claim that the bank has on you in the future. The bank will have created a deposit, a liability for itself, which is a claim that you have on the bank. If you then withdraw that deposit, or if you engage in a transaction which involves moving those funds to somebody else's account with another bank, that's when your bank will need some reserves. If your bank doesn't have sufficient reserves to cover the net outflows which are taking place from it, the movements of funds from it to another bank, then under normal circumstances, well, there's a variety of ways your bank can look for the additional reserves, and they'll do it whichever is the cheapest way. But the way we usually talk about is that they'll borrow overnight from other banks which have got excess reserves. And in most countries, if a bank leaves it too late in the day to get that organised, then the bank might be forced to go and borrow directly from the central bank, which for historical reasons is sometimes called discount window lending. And there's a punitive interest rate on that, so banks don't do that very often. There are also frown costs involved in doing that. The central bank doesn't like private banks doing that very often. That's the way that the system works in Australia, and it's the way it used to work in the UK and still largely does, although QE has complicated things a bit.
So I love that you just said frown costs, as in FROWN, yeah?
Yes, it's something which,
that's the first time I've heard that.
Seen as, yeah, it's something which is not going to please the regulator. If a private bank I mean, it shouldn't be like this. This shouldn't be the way that the system is organised. It's much more complicated everywhere, really, than it needs to be. But in most countries, banks looking for overnight reserves are supposed to be borrowing from other banks that have got excess reserves, and they're not supposed to become dependent on frequent overnight borrowing or short-term borrowing that the bank itself has initiated from the central bank.
Got it. Okay. All right. So
we're probably even there getting a bit too complicated.
Yeah. Okay. Well, I think we might be able to unpack it. Here's what I'm thinking. So I have a friend. I say this a lot on this podcast. I have a friend, and it's almost like a section in the podcast. It's welcome to the I Have a Friend podcast. So yeah, I've got a friend. Let's call him Jim. Right. I have an account at NatWest. He has an account at NatWest, and we both have £1,000, and I send him £500. NatWest changes my balance to 500, his balance to 1,500, using a computer spreadsheet somewhere. Am I right?
You are, and reserves don't come into it at all.
That's right. Yeah. So central bank's just not involved at all because we're at the same branch. So
you're in the same. Well, you're at the same bank.
Yeah. Sorry. Yeah. Same bank. Rather. Yeah. And if that's the only transaction that happens all day at NatWest, nothing's going to happen central bank wise for NatWest. Yeah,
absolutely. Which, interestingly, I suppose means that if we didn't have physical currency, well, I don't know if it's interesting or not, but I'm going to say it anyway. And if there was only one bank, then reserves would be necessary only for transactions between the private sector and the government.
Okay. So, and this is kind of an aside, and I don't know if you can answer this, but if we're at the same bank and my balance goes down and his balance goes up by the same amount, is that an automated process, or is there a flaw in the head office where somebody's really sitting there at a computer typing the numbers in? Would you know any about that?
It depends on the nature of. It's probably an electronic transaction these days, isn't it? So, and with faster payments, such as you have in the UK now, these things happen more or less instantaneously.
Yeah.
So the one account will be debited and the other account will be credited at the same time. Actually, of course, faster payments is irrelevant here, really, because it's the same bank. But the two transactions will get processed at the same time.
Right. Okay. So, now it's the same situation. I'm transferring my money to my friend, except I have an account at NatWest and Jim has an account at HSBC. At that point, my bank marks down my balance by 500, but then my bank tells HSBC to mark Jim's balance up by 500. Is that correct?
That's right, yes. And the way the system works in the UK now, that particular transaction will be batched with millions of other transactions. And so it won't... the banks, obviously, they're not transferring tiny amounts of reserve through every single retail transaction. And I think in the UK now they clear the net flows between banks 3 times a day.
That's interesting.
That's the way it works now. Yes, it didn't used to work like that. It used to be overnight, but I think it's 3 times a day now. In Australia, it's more frequent than that.
Wow.
But they batch the transactions. When we're talking about very large-scale transactions, they're cleared using something called real-time gross settlement. And it is literally the case that the amount of reserves is transferred from one bank to another at the Bank of England as the transaction takes place or within minutes of it. When we're talking about transactions of, I don't know, let's say below £250,000, retail, more retail scale, then they're batched.
Right.
And there's a system where the net flows are calculated, and a particular bank will then have its reserve balance credited or debited by the net amount, depending on whether there's been a transfer into accounts of that bank or out of it 3 times a day. I think that's right.
Great.
So I dreamed it.
Yeah, that's an exciting dream, Steve. I want you to keep dreaming.
But let's suppose that transaction was the only one.
That's it. That's what I was going to get to. Now,
that transaction was the only one. Your bank would have its reserve account debited, and your friend's bank would have its reserve account credited. If your bank was short of reserves, it might borrow reserves overnight.
Great.
From your friend's bank in order just to keep the system continuing to operate.
Right.
Over time.
Now,
that's what we call money market transaction.
Brilliant. Now, what I've written down, but is now I know is incorrect, is that the central bank would be involved, and the reserve account would decrease by £500, and my bank and my friend's bank account would increase by £500. But it wouldn't be that.
Yeah,
it wouldn't be
what would happen.
Right. Okay. It would be literally. It wouldn't be a fraction of £500.
Why would it be a fraction of £500?
Because they only need to hold. They only.
No. The transfers between, essentially, when you have an account at your bank has made a promise to you to make payments on your behalf using its reserve account.
Right.
Now it doesn't. The only way that you can put funds into your friend's bank account is to, assuming that you're not going to withdraw physical currency and give it to your friend who's going to put it in your friend's bank account, is for your bank to use its reserves to make that payment on your behalf. But that doesn't mean your bank needs to have a high level of reserves, because, of course, there are payments going out of your bank to accounts at other banks. And at the same time, there are payments coming from other banks and going into accounts at your bank. And then on top of that, your bank has a portfolio of safe and short-term, we say, liquid assets, which it can sell to raise additional reserves if that's the best way of boosting its reserves when it needs to. And on top of that, your bank has a variety of ways of borrowing reserves, including borrowing overnight from the other banks.
Great stuff.
But yes, you're correct. When you spend that $500, your bank, if that's the only transaction in the country, your bank's reserve balance will go down by $500 at the central bank. Yes.
Great stuff.
Oh, sorry, I should say £500, shouldn't I?
Yeah,
I've been here too.
We knew what you were talking about.
Yeah.
Let's come back to the central bank in a second. Just quickly, I hope it's quickly. Let's talk about the commercial bank loans. Okay.
Yeah.
So I need to borrow £1,000 for whatever reason. I go to my bank, I take out a loan for £1,000, and we'll say that my balance was zero to start with. Now, this has been discussed many times before in different places, but we have to go over it again. My bank doesn't check its reserve account to see if it can make the loan. As you said earlier, in fact, in this conversation, banks don't lend out reserves. The reserve account at NatWest is just for the interbank stuff. So my bank analyzes whether or not I'm creditworthy for the loan. That's all they do. And if I am, they make the loan. Correct?
Well, whether you're creditworthy and whether you're able to pay a rate of interest which allows them to make a profit, and also to have a sufficiently high premium to cover them for the risk of lending to you, yes.
Right. Okay. So if I meet all those conditions, they make the loan by typing £1,000 onto the spreadsheet field for my bank account, and that's £1,000 of bank credit. That's how it happens.
That is often how it happens. Sometimes the bank will just issue a bank check, and things are a little bit different. But it's simpler to talk about this example. So yes, the way we usually explain it, which is the way it often happens, if a bank lends £1,000 to you, then you now owe the bank £1,000, but you also have a deposit at the bank of £1,000.
Now, and
those two things happen at the same time. So,
right, this is how I think about it, and I think I asked you about this when we were messaging a couple of years ago, and apologies if this is a clunky way to say it, but I don't know, I can't let it go. So this is how I like to think about it. They give me £1,000 of bank credit, which I can go out and spend. But And at the same time, I promised to pay them £1,000 at some point in the future. So I always say it's as if I've given them my money, like my money that I print, because, money is an IOU. So it's like I've written them an IOU for £1,000, but obviously I don't have to do that in the real world because the bank does it for me. They create £1,000 liability in my name on another column. And then that
absolutely
got it right.
That's literally correct. You've exchanged promises to pay.
Great.
There are different terms on those promises to pay, but the bank has promised to pay you cash if you want to withdraw that £1,000 in cash, or to pay your bills on your behalf if they're going to be transferred into somebody else's bank account with another bank, and you've promised to pay the bank obviously the £1,000 and interest on top of that in the future as well.
So my £1,000 liability is their asset. And
absolutely.
Great. Yeah. And this is an aside, and I don't know if this is the case, but is it the case that they take my promise to pay £1,000 in the future and bundle it up with other things, and they can then sell it to another financial institution if they want? Is that what mortgage-backed securities are, for instance?
Mortgage-backed securities, that's what mortgage-backed securities are. Yes, they're not. The market for mortgage-backed securities is not so big as it was 10 years ago.
Sure.
So banks are much less reliant on securitization for funding now than they were. And funding is an issue for banks, because although a bank can always lend to you by creating a deposit for you to spend. That's absolutely right. And of course, as people often say, those bank deposits are part of the official definition of the money supply. So banks literally are creating money when they lend to you. Of course, when you spend those funds you've got on deposit with the bank and they're transferred to some other bank, then your bank has to replace that funding, or it has to be able to make payments from its reserve account. I've said that your bank can borrow overnight in order to make those payments, but that's a risky and potentially expensive way of funding a bank, and it's also not a way of funding the bank which the regulators will allow the bank to get away with in the long run anymore. And so both in order to satisfy regulators and also in order to try and make more profit, banks will look for longer term, more stable and hopefully lower cost funding as well. Banks these days are competing much more aggressively for savings deposits and term deposits than they were sort of 10 or 15 years ago, when they would have been using more securitization than now.
Great. So now this situation where I've gotten £1,000 worth of bank credit, I can move it around. I can put it in, say, Jim's bank account or a friend's bank account. But the reason we say that no net financial asset has been created is because my liability, which is my money, my IOU, and the bank created credit, they both net to zero. Is that right?
Absolutely? Yeah. Yeah, there's no net financial asset or net financial liability being created in the private sector.
So there's a difference between this type of credit creation that we just talked about and when the government spends.
Yes, if the government spends into your account, then you have that deposit at your bank. Your bank, other things remaining equal, will have also a bigger reserve balance at the central bank. And you don't have, you've got that financial asset, you've got your bank deposit, you don't have a financial liability against it, you've got no debt that you have to repay.
So it's a net financial.
You have more net worth, more net financial assets than you had before, yeah.
And then that's what we say is the whole private sector as a whole, the more government spending happens, the more net financial assets there are out there in the system, right?
Yeah, there's... if we just sort of include the central bank in with the government for the moment, because in most countries the government owns the central bank, and even in the US, where technically they don't, effectively they do. We won't get into that now. Yeah. So there's the government, there's your bank, and there's you. If the government gives you £100, then what has happened is you now have that £100 of additional assets and no more liabilities. So your net financial assets have gone up by £100. As far as your bank is concerned, your bank has that deposit liability to you. So it has £100 more liabilities, but it also has £100 more in its reserve account at the Bank of England. So your bank's net financial asset position hasn't changed. The government, the Bank of England, between them, they have created £100 more worth of financial liabilities as far as the government is concerned. But as we know, the government, because it's the currency issuer, can't run out of pounds, can never become insolvent as long as the financial liabilities that it takes on are denominated in its own currency. So there's no risk of the government becoming insolvent. Your balance sheet is stronger, and your bank has just been there basically as an intermediary.
And what we say, MMT says, when the government spends the pounds into existence, they stay out there forever in bank accounts in various forms, which we can go into in a minute, but they stay in the banking system until someone uses them to pay taxes. And when you pay,
that's right.
You're just returning the pounds that they created to them to be destroyed, basically.
Yeah, absolutely right. And the national debt, or the government's debt, is just pounds that in the UK is just pounds that the government has spent into the economy and not taxed out of it yet.
So if the NatWest create that £1,000 worth of bank credit and they put it on my spreadsheet entry, and NatWest's reserve account at the Bank of England, again, we're presuming that I'm the only thing that's happened that day. So the NatWest reserve account at the Bank of England needs to go up by £1,000.
No.
Okay.
No. If the National Westminster Bank lends £1,000 to you, then you will now have £1,000 on deposit at the National Westminster Bank. So the National Westminster Bank has made a promise to pay you £1,000 in cash, or to pay your bills for you up to that £1,000 when you want the NatWest Bank to do so. If that £1,000 is sitting there in a transaction account. The NatWest has an asset, which is the loan that they've made to you, which is a promise you've made to the NatWest Bank that you'll repay that loan in the future. Reserves haven't come into it.
Okay.
The reserves will never come into it unless or until you spend out of that £1,000 deposit you've got at the NatWest Bank, and that expenditure involves a transfer of funds from the NatWest to another bank.
Okay.
That's when the NatWest reserve account will be important, because it's at that point in time that the NatWest reserve balance will be debited.
So the reserve balance won't go up as soon as the loan is made. What happens is the banks do their thing all day. They move money around between accounts within the same bank, as we discussed, and then between accounts at different banks, as we discussed, and they create credit out of thin air and move that around as instructed by their customers. Just those three things we just outlined. But then I wrote down at the end of the day, but I've learned since talking to you, it's 3 times a day in some places.
It used to be at the end of the day.
Yeah, right. And that's where we get the overnight rate thing. Okay. So, but now it's 3 times a day. Some banks will have a higher reserve balance than they require. And some banks won't have a high enough reserve balance to be in compliance with the law. Now, I know that you've said that there's no minimum reserve requirement now in the UK. It's only in the US. So,
well, in a lot of countries there are minimum reserve requirements.
Right.
Yeah, but all that doesn't really change things very much. Where there is no minimum, the minimum is effectively zero. So if the minimum is 10%, then as in the US, then that just means banks hold a higher average level of reserves over time. In order to keep control over interest rates, the central bank has to ensure that those sufficient reserves are in the system. It doesn't actually change anything particularly important.
So at the end of the day, all these 3 times a day occasions, the banks who have higher reserve balances than required lend reserves to the banks who need reserves at a rate of interest. That's the way we prefer to do it, and the central bank gets involved if there's not enough, if there are not enough reserve pounds system wide. Is that?
Well, banks can arrange interbank loans at any point in time. Those 3 times I was talking about, that's when the transactions are cleared. But that's only retail transactions. As far as wholesale transactions are concerned, when we're talking about transactions, they might be real estate ones, but very often, most of the time, we're talking about transactions on financial markets. They are cleared between banks' reserve balances when they happen. It's called real-time gross settlement. That's happening all the time.
Okay. So
But the banks can borrow and lend at any point in time. The 3 times a day is those retail transactions between bank accounts being cleared as a result of funds being transferred from one bank to another. So if there are more funds going from NatWest accounts to Lloyds accounts than in the other direction, and if NatWest and Lloyds were the only 2 banks in the system, because in reality it's complicated because there's multilateral netting going on, then there'd be a transfer from NatWest's reserve account to Lloyd's reserve account, just to clear everything up, just to clear the books so that everything can continue.
Okay. So the rate, the interbank rate known as LIBOR, can we talk about where that comes from?
LIBOR, first of all, is being scrapped in 2021.
Okay, fair enough.
As an indirect result of the scandals over how it was being gamed a few years ago. LIBOR is the rate of interest on wholesale interbank loans, not just in pounds, but in a variety of currencies, for 3 months, 6 months, 9 months, 12 months. I can't remember what other maturities there were. They've reduced it over time. And that's important as far as the international banks are concerned. It's not a term which is used in the context of the domestic UK banking system. In the domestic UK banking system, the interest rate the average interest rate, based on what happened the previous day, on interbank loans is called SONIA. That's what it's called in the UK. And Sterling Overnight Interest Average Rate, I think it stands for. You'd have to look it up on the Bank of England site. Remember, I'm an Aussie. I'm not. It's a long time since I was in the UK.
You haven't lost the accent.
Rate, no. Well, that's because I'm old. The more important interest rate in the last 10 years in the UK, about 10 years, because of quantitative easing, is the base rate.
Right.
Or the bank rate, sorry, they call it these days. Sometimes it's called the base rate or the bank rate. The bank rate is the rate of interest that the Bank of England itself pays on bank reserve balances. And the issue here, I know you're going to come on to quantitative easing, the issue here is as a result of large-scale Bank of England purchases over the years of both government bonds and private sector securities, corporate bonds as well. The banking system has a far higher level of reserves than it needed to. Consequently, there's much less interbank lending because it's rare for banks now to run very short of reserves because the Bank of England's basically forced additional reserves into the system. And once those reserves are in the system, the banks can pass them on to each other, but there's no other way of getting rid of them. So because the banks all have more reserves than they need in the UK these days, as a result of quantitative easing, the SONIA rate is not so important because there isn't much overnight lending between the banks taking place. And instead, the key reference rate in recent years has been, as I said, the bank rate. That bank rate is simply the rate of interest which the Bank of England itself pays on private bank reserve balances.
Okay, so let's just back up to the SONIA rate for a second.
Yeah.
In normal times, because you never know, it might get normal again. You never know.
Well, it will take a while. They've stopped increasing bank reserves. They've stopped doing the quantitative easing, but they haven't unwound.
Yeah, right. Yeah.
Even any of it, really, basically, yeah.
So that SONIA rate was important before there were excess reserves.
It was the rate that the Bank of England used to target. The simplest way of explaining how things used to work in the UK is to explain how things do work in Australia.
Oh, great, brilliant.
Because we've never had quantitative easing. So in Australia, we have an official interest rate which is called the cash rate, which I guess equates to the SONIA rate that I was just talking about. The cash rate is the rate of interest on overnight or 24-hour interbank loans between private banks for the reasons that I was talking about before.
And let me just jump in to remind that the reason that they need to do this interbank lending is in a normal situation, there would be banks with excess reserves and banks with not enough reserves. So they're looking to, the banks with excess reserves are looking to lend and the banks with not enough reserves are looking to borrow. Is that right?
Because they're not allowed to run an overdraft. 0 is the minimum.
Right.
As far as that reserve balance is concerned. Now, the Reserve Bank of Australia announces a target for the cash rate, and for the last 20 years or so, the actual cash rate, the average rate of interest at which the banks actually do lend to and borrow from each other overnight, has hardly ever been more than 1/100th of a percentage point away from the Reserve Bank's target for the cash rate. So we just basically say these days that the Reserve Bank sets the cash rate. The cash rate, though, is not a rate of interest at which the Reserve Bank lends to anyone. It's not a rate of interest the Reserve Bank pays to anyone. It's the rate of interest on overnight loans between private banks. Now, the way the RBA is able to control it is that the RBA, let's simplify things a bit. I'm not going to go into the full complication of it. The RBA, let's say, buys and sells government bonds from the banks on a daily basis. And it does this in order to try and fine-tune the amount of cash that banks have in those reserve accounts. So if the RBA expects tomorrow that banks will be short of funds in their reserve accounts, then to stop the cash rate increasing above target, the RBA will feed extra cash into the system by transacting with the banks, basically buying government bonds. They'll invite the banks to bid for the business, and they'll deal with the banks that give the Reserve Bank of Australia the best deal. If, on the other hand, the RBA expected the banks to be holding too much cash tomorrow, that might be the case if there was a big government bond issue which was coming up for maturity. So if the Reserve Bank was expecting the Treasury to be putting cash into the banking system, and there'd be too much cash there and it put downward pressure on the cash rate, the Reserve Bank would want to take that cash out of the system, and they do that by selling government bonds from their own portfolio. And when banks and other investors buy those government bonds, it reduces the reserves in the system. It's a little bit more complicated than this. It involves transactions called repos these days, which if anybody's interested, they can look up what a repo is online on the Bank of England or the Reserve Bank of Australia website. But basically, the story I'm telling is correct. The Reserve Bank trades on the money market, buys and sells government bonds and a few other odds and ends to try and fine-tune the total amount of cash in the system, to give the banks an incentive then to lend to and borrow from each other at the cash rate. Really complicated. It doesn't need to be this complicated, but that's the way it works.
No, it needed. Now, okay.
That's what the cash rate is.
Okay.
There is a lower interest rate than that, which is equivalent to the bank rate in the UK. It's 0.25% lower than that, and it's the rate of interest that the Reserve Bank pays on private bank exchange settlement balances. Now, if we had quantitative easing in Australia, and so all the banks had far too much cash, and the banks stopped lending to each other or borrowing overnight, then the cash rate would basically become redundant and the official interest rate would fall to this floor. That's what's happened in the UK. The official interest rate, the bank rate, is the rate of interest that the Bank of England pays on reserve balances. There's a higher interest rate than the cash rate as well, which is a punitive interest rate at which the Reserve Bank lends overnight. And the same sort of thing exists in the UK. The Bank of England has a higher interest rate at which it will lend overnight to a bank which in an emergency needs to borrow cash overnight from the Bank of England. There is the SONIA rate in the middle, and there's the bank rate, which is the floor. That's the way the system works. And if you do quantitative easing, then it's the bank rate that becomes the relevant one.
Okay, so all of these rates that you just talked about, that's what forms the basis of the interest rate that normal people, usually retail banking, the price of money. When we want to go into debt, all of these rates that you just talked about affect our ability to borrow.
They affect the whole of the structure of interest rates, yes, to a greater or lesser extent. If we're talking about fixed rates on mortgages, they're slightly less affected by the bank rate. If we're going back to the UK again, they'll reflect instead what the market expects to happen on average to the bank rate across the period of time when the interest rate is fixed. But generally speaking, yes, interest rates in the UK these days are loosely or tightly tied to the bank rate. And actually the bank rate is I suppose you could say, is simple in the UK now. It is just the rate of interest that the Bank of England pays on bank reserves.
Because quantitative easing has taken one of those rates out of it in terms of importance.
Well, kind of taken both the other two rates.
Right, yeah.
Really.
Right, yeah. Okay.
Yeah, it's the only one that matters.
Right, okay.
And the same thing is true in the Eurozone. The key interest rate in the Eurozone is the rate of interest that the European Central Bank pays on bank reserves. Bizarrely, you might think that's a negative interest rate. That's how they have a negative official interest rate. And the same thing is true in Japan. The system that we now have for bond issuance in countries like the UK and Australia really evolved into something like what we have now in the early 1980s. Let's put it like this. When the government spends, as we know, that involves the creation of money. If the government pays money, the UK government pays money to Christian Riley, your bank balance goes up, your bank's reserves at the Bank of England go up as well. That's how that happens. Of course, when you pay your taxes, then your bank account goes down and your bank's reserve balance at the Bank of England goes down as well. If the government is running a deficit, that means the government's spending more than it's raising in taxes. That means the government's going to be putting more money into the system than it's taking out. That would mean bank reserve balances would go up. And they'd go up quite a lot. And that would mean that if the government left it to the Bank of England to manage the amount of cash in the banking system, the Bank of England would have to engage in very high-scale transactions in order to do that. So to make the job of managing interest rates simpler for the central bank in countries like the UK and in Australia, when the current system for interest rate management came in the early 1980s, the government and the central bank came to an agreement that the government would always issue government bonds in, roughly speaking, the right amount to cancel out that net spending. So government spending puts money into the banking system. Taxation takes money out of the banking system. If there's more government spending than taxation, then the amount of reserves in the banking system will be going up, and that makes it more difficult for the central bank to keep control of official interest rates. In order to help the central bank keep control of official interest rates and make it more easy for them. This is the story anyway. In the early 1980s, governments in many countries around the world started to be much stricter about selling government bonds to make up the difference between government spending and taxation. Because by selling those government bonds, as you were just saying, you withdraw reserves from the banking system. Again, or to put it another way, instead of the NatWest Bank having a transaction account at the Bank of England, they've now got effectively a term deposit.
A savings account.
A savings account at the Bank of England. I'm sorry that's a little bit involved.
No, it's perfect.
Basically the story.
Very clear. Yeah. No.
It misleads people because, of course, they've done that now for so long that people imagine that there is some necessity to sell those government bonds to pay for the government spending. People think either taxes have to pay for government spending or issuing government bonds have to pay for government spending. They think the taxes and the government bond issuance come first, and that's not the way in which it works. The government spending comes first, then some of that money is withdrawn through issuing taxation, and then the rest, more or less exactly these days, is converted from that transaction account at the central bank to a savings account at the central bank for reasons of interest rate management.
Great.
Now, we could manage interest rates in a different way, in which case that bond issuance would be unnecessary. And indeed, post-quantitative easing, the UK has been managing interest rates in a different way. And basically, we've had then the weird and unnecessary process where you've had the UK government selling new government bonds to market makers in gilts, new gilts, and then you've had the Bank of England buying those gilts again and taking them back out of circulation and calling it quantitative easing. And of course, what that's done, as we were saying before, is it's increased the amount of reserves in the banking system. Well, they could have just left the Bank of England out of the whole story, really, and just had the Bank of England buying the gilts directly from the government. It would have been much simpler. You would have ended up with the same final result.
The central bank sells treasury bonds to commercial banks. How does the central bank acquire the treasury bonds? Sorry if this is just off on a tangent, but does the central bank tell the treasury?
It has to buy them first.
Right. Okay.
Central banks usually have a facility where they can buy limited amounts of treasury bonds from the treasury. This is in the modern system, but they don't do that very much. We're usually talking about them buying them. In the case of the UK, from gilt edge market makers on the secondary market as part of their monetary policy operations when they want to feed more cash into the system.
Right, that's when the central bank.
How it used to be.
Right, okay.
Years ago, it was the central bank which organised the sale of gilts in the first place. But in countries like Australia and the UK, in the 1990s, in most countries' cases, the government took the issuance of treasury bonds away from the central bank, and there's now the Debt Management Office in the UK that does it. It's called the Australian Office of Financial Management in Australia. It's part of the Treasury. It's separated out. It's really complicated. It doesn't need to be. We don't actually need to issue government bonds at all. We should, instead of talking about there being effectively savings accounts at the central bank, we should call them term deposits at the central bank. We should never issue any gilts at all, so that fund managers can hold instead of holding gilts, they can hold term deposits at the Bank of England. Nothing important would change, but it would make the whole system immensely simpler than it is now, and transparent.
We've had to go into all this complexity because that's the system, and I wanted to sort of correct people's understanding of quantitative easing, because a lot of people, I think, they think QE was the government manufacturing pounds, giving them to banks and saying, here, go and lend them.
Yeah, the quantitative easing is just an asset swap. When it started, when central bankers in the US and the UK, and they'd done this some years earlier in Japan and in the Eurozone and in one or two other places like Denmark and Sweden. When central bankers got going with quantitative easing, why did they do it? They did it because they cut interest rates to zero or as close to zero as at the time they thought they could go. They hadn't at that point in time gone below zero, which in some places they have since. That seemed unthinkable at the time, to have negative interest rates. Zero interest rates didn't seem to have done anything to help the economy recover. What was needed to assist the economy in recovery was governments to run bigger budget deficits, bigger fiscal deficits. But that was down to politicians. That was not anything that central bankers could do anything about.
Right.
So the central bankers were thinking, oh my God, we've got to do something. And the only thing left they could possibly do was to try quantitative easing. The trouble with quantitative easing is it doesn't work because you're not giving money to anybody. Central bankers are not allowed, generally speaking, to give money away. They can engage in financial transactions in a range of financial assets or securities. They can lend to certain institutions under certain circumstances, but they can't make welfare payments. They can't give money away. That's the role of the government and Parliament and the budget and all that. That's fiscal policy. So what quantitative easing involved, at least insofar as it involved the central banks like the Bank of England buying gilts, buying government bonds, is that the central bank, yes, sure, you could say created money in order to purchase government bonds from the private sector. But now the private sector, whereas previously it owned those government bonds, which were interest-bearing liabilities of the government.
They already had those pounds out there already. They were already in the system.
That's right. Now they don't have those government bonds anymore. Now they've got higher reserve balances at the Bank of England, which are also interest-bearing liabilities of the government, where the government's broadly defined to include the Bank of England. So actually government bonds and reserve balances at the Bank of England are quite similar assets. You've basically swapped apples for slightly different apples. That's all that's happened. As a consequence of buying those government bonds, you've driven their prices up. And that drives the subsequent rate of return on them, the interest rate on them, down. Yeah. So one thing that quantitative easing did was it pushed long-term interest rates down towards zero to match short-term interest rates. That then gave fund managers, people managing your pension fund, if you've got one, an incentive to, there was no point holding too much in government bonds anymore. You're not getting any return on them. So it gave them an incentive to take more risks. And that helped, perhaps, this is a controversial issue, but that may have been a factor, for example, driving up the US stock market in America, the large-scale quantitative easing over there. And with higher share prices, then that makes some people feel more wealthy than they did before, so they might go and spend and borrow more. And it might make it easier for companies to raise money if they want to engage in investment. And that might stimulate a little bit of additional spending in the economy. But there was massive quantitative easing. So the amount of what we call base money, which is basically more or less the same thing as bank reserves at the central bank. It's bank reserves at the central bank plus physical currency. In some countries like the UK, it was multiplied by 5 quite quickly. And in some countries, like Switzerland, the monetary base multiplied over the last decade by 10.
Wow.
With virtually no effect on the economy and no effect on inflation at all. Central banks generally in these countries continued for years to miss their inflation targets on the low side. So they did massive amounts of quantitative easing, and they had virtually no impact on inflation. They had some impact on financial markets, but it would have been far, far more effective for governments just to run bigger budget deficits. That's what should have happened after the financial crisis. They should have bailed out Main Street, as they say, and propped up the economy, rather than leaving it to central bankers to do something which was largely ineffective, but which was the only thing legally that central bankers could do.
So it would have been better because, as we said earlier, that banks have infinite liquidity, and the reason that the banks weren't lending was because people weren't walking into the bank and going, "Here, I want to take out a loan for my small business and expand it." Nobody was doing that because the economy was so bad over here.
Yeah, because they didn't have any customers. Nobody's going to try and expand their business when they've got no customers. Interest rates were as low as they could go.
Yeah.
Initially, some of the banks were being very careful on their lending decisions because of other issues that we haven't gone into in terms of how they're regulated, the level of risks they're allowed to take. But for the most part, what you've just said is right. It was possible to borrow money and borrow relatively cheaply if you were a good credit risk with a good business idea, but there was no demand out there.
I think if I've interpreted Warren Mosler correctly, what he says about QE is because the government pays interest on bonds, and QE is swapping bonds for non-interest-bearing pounds. Also, I've heard other people say you can think of a £10 note as a £10 bond, but it just doesn't pay any interest. Because you're
swapping, it does pay. Bank reserves, they do pay interest on bank reserves. They just don't pay a good rate of interest.
Right. Okay. Well,
they only started doing that about 10 years ago.
Right.
At least in the US, it was 10 years ago. In Britain, it was a little bit longer ago than that.
Right. Okay.
But in fact, in Britain now, that's what the bank rate is.
Right.
It's the rate of interest on bank reserves, but it's a lower interest rate than the interest rate on gilts.
Right. Okay. So Warren Mosler is saying QE is removing these interest payments from the government to the economy by doing QE. So it's lowering aggregate demand and hurting the economy in that way. Have I interpreted him correctly? You have, and that's absolutely correct. It's probably not a particularly these days important effect quantitatively, but it is correct. Basically, I prefer to say it just doesn't achieve anything. Right. Okay. I know we've spent an hour sort of unpacking this so that people can understand it, and the takeaway is
it's not
QE does
money.
Nothing. Yes.
That's the important thing. It's not free money. If somebody comes along and buys something off you and pays you a fair price for it, they're not giving you free money.
Got it. So I think a useful thing to define right now is that there's a difference between capital requirements and reserve requirements for commercial banks.
Yes, there is. That's something I said at the beginning. The word reserves is used in two different contexts, and many economists get confused about this. We've been using the word reserves to stand for the electronic cash which banks hold at the central bank. Now, that is an asset of the private banks. That's something the private banks own. But when people talk about capital reserves are sometimes called the net worth or the equity capital of the banks. That is the difference between the total value of all the assets that a bank holds, all the things a bank owns, including the cash it's got at the central bank, although that's only a very small part of it, minus the debts the bank has. Assets minus liabilities gives you those capital reserves. And those capital reserves are important because they're a sort of buffer stock. If your assets, if what you own is worth more than what you owe, then if you needed to, you could sell off your assets and you could pay off all your debts. If you've got a big amount of capital reserves there, this is the big gap between the value of your assets and your liabilities, then you can afford for your assets to shrink because of, let's say, bad debts, because you've made a lot of loans that people don't repay. And you'll still have enough assets there so that you could still pay off your debts or your liabilities and meet your obligations to your depositors and everybody else that's lent money to you without failing. If banks' capital reserves go negative, then regulators are supposed to close banks down. Banks are then insolvent. But sometimes during banking history, banking regulators and central bankers have, let's say, they've cast a blind eye towards insolvent banks and allowed them to continue trading when perhaps, strictly speaking, they shouldn't have done. There are rules, which again are quite complicated, but basically those rules say the amount of risky assets that you're allowed to hold, how big the bank is, and how risky the bank's activities are allowed to be is limited by the amount of capital reserves you have. But what's confusing for people is these capital reserves are not themselves something that the bank owns or holds somewhere. They are just the difference between the value of the bank's assets, the value of everything the bank owns, and the value of the bank's debts or liabilities, including its deposits.
Okay.
That's what the reserves are. Now, that's completely different to using the word reserves to stand for the amount of electronic cash the bank has at the central bank. And people regularly confuse those two things. It's very easy to get confused between them. Whereas banks don't need reserves at the central bank before they lend, banks do need capital reserves before they're allowed to take on more risks and lend more.
But that's a regulatory thing. It's not a material thing where, they could get into the danger zone without, and overseers not picking up on it.
Yeah, that's a regulatory thing. It's a set of rules which was negotiated between the rich country central bankers in the late 1980s and has been changed. It's always inadequate, so they changed it in the early 2000s. Then the GFC happened, so they changed it again.
Right. It's like the debt ceiling in the States. It just keeps, it just keeps getting changed to suit politics, I guess.
It does. I don't think we'd want to get into this now, but modern monetary theorists like Warren Moser and Bill Mitchell have come up with a much more effective and simpler way of regulating banks than the way it's done now. In terms of the risks banks take broadly, what I've just spoken to you about is how it's done now.
Yeah.
There is an assessment of how risky banks' assets are, and you basically multiply the average risk by the value of banks' assets, and that tells you the risks to which a bank is supposedly exposed. And then you need to have an amount of capital reserves, which is your total assets minus your liabilities, which is at least a certain fraction of those, what are called those risk-adjusted assets.
It might be
That's the way that the rules work.
Might be worth jumping in and saying what Glass-Steagall was.
Yeah, Glass-Steagall was a law that was introduced in the US in, I think, 1933, after the big banking failures that followed the Wall Street crash, which separated out risky banking business, often called investment banking, from everyday banking business, often called commercial banking, ensuring that commercial banks did not take silly risks with depositors' funds. Basically, that's the idea, I suppose. Now, it's more complicated than that, and gradually, from the 1960s onwards, there was pressure from American bankers to relax the interpretation of the Glass-Steagall Act, particularly because it didn't apply to foreign banks that they saw themselves in competition with, for example, European banks. But it wasn't finally scrapped, that piece of legislation, until 1999. And this was one of the acts taken under the Clinton presidency to, I suppose you could say, substantially deregulate American banking and finance, that helped to set the system up for the global financial crisis. 8 or 9 years later.
Yep, it was Clinton.
Well, he ran a budget surplus as well, which didn't help too.
Yeah,
that
exactly.
Pushed the private sector into debt, and first of all fueled a stock market bubble, and then after that burst, it fueled a property market bubble.
So, and also surplus, it just sounds like such a good word, but when you drill down into it, when the government's running a surplus, the private sector, you and me, need to go into debt to do it, and that's what happened, and that debt collapsed.
Yes, what happens when governments run budget surpluses is either the country needs to run a big trade surplus, which means you're exporting the problem to somebody else, you're doing a sort of Germany, or the private sector has to go further and further into debt, and the financial system will become more fragile, and eventually there'll be a crash. Or I suppose the third option is that if the private sector doesn't choose to do that, then you'll have a recession sooner rather than later. It just won't be. Yeah. You won't have the financial crash that goes with it.
Go
on. Economies cannot grow long absent a trade surplus without a government deficit. This is something which is logically true. When you look through models where all the accounting's done properly and they make logical sense, it's also something which is empirically true. People imagine that government budget surpluses lay the foundations for stable and sustainable economic growth, because this is what politicians and neoclassical economists that don't understand balance sheets keep telling them. But it's bizarrely wrong. I say it's bizarrely wrong because you just have to look at, it's easiest to do this for the US because people like Randall Wray have written on it so extensively, but you just have to look at US economic history. Every time the US has run a government budget surplus, there's been a recession around the corner, with the possible exception of the Clinton surplus, where they managed to delay the recession for about a decade by having a private debt bubble. But then it wasn't just a recession, it was a great recession. So responsible fiscal policy means governments running budget deficits in almost all countries, almost all the time.
And when the private sector bubble is inflating, is that what I hear called Minskian fragility?
Yes, Hyman Minsky was a very interesting man. If people would like to check it out, there's about a 4-minute video, brilliant 4-minute video by Randall Wray standing outside, I don't know whether it's UMKC in Kansas City, but outside some university, talking about his former colleague and prior to that his teacher, Hyman Minsky, and explaining that the lead up to the financial crisis, it wasn't a Minsky moment, it was more like a Minsky half-century.
Right.
Because Hyman Minsky explained that at the end of the Second World War, the US private sector was flooded with safe government debt. So the US private sector had a very safe set of balance sheets and a highly regulated banking system. And down through the years, gradually, pressure for deregulation and banking innovation and changes in balance sheets were increasing the degree of risk in the US banking system, and there were minor problems in the 1960s and 1970s, but they were easy to get out of. because things hadn't got too far. So just lower interest rates or the government running a bigger budget deficit was enough to bail the system out. When the financial system looked as though it was possible there could be a major downturn. Then, however, there were more frequent and more severe financial events, including the 1987 stock market crash in the 1980s and in the 1990s. And they were getting more and more difficult to manage. There was almost a major financial crisis in the US at the end of the 1990s. A very large hedge fund called Long-Term Capital Management crashed, and that almost brought the system down. And then finally, well, every time that the US government and the Fed had managed to bail the system out during the 70s and the 80s and the 90s, when it inflated again, nobody'd learned any lessons because there'd not been a major downturn, and so even bigger risks were taken on, and there was even more pressure to deregulate.
Stability is destabilizing.
That's right, and then eventually you get a crash where even zero interest rates and even running the sort of fiscal deficits which politicians are prepared to tolerate and say we won't go beyond that won't be enough to prevent there being a major prolonged economic slump, which is what happened after 2008. And some people call that event a Minsky moment, which I think the US fund manager Paul McCulley came up with that term. Right. But yes, Hyman Minsky described all this many times between the 1950s and his death in 1996. And when the crash happened in 2008 and subsequently, it bore considerable similarities to Minsky's analysis. And that's why everybody started talking about Minsky, whereas a few years before he drifted into obscurity. And if you've been at a university learning economics in the 1980s or 90s or 2000s, nobody would have mentioned Hyman Minsky. Wow. Now everybody knows Hyman Minsky's name.
Wow. So, it's been a great chat, Stephen. Thanks for taking all this time and walking us through all this guided tour of private credit creation and government credit creation. I'm very much about trying to find a stimulating endpoint to get people interested in MMT. I know this is this comes up a lot when people talk about MMT. In this last few minutes that we've got, what would be your MMT elevator pitch? I hate to use the word elevator pitch, but I can't think of a better word. Sorry.
Modern monetary theory is the economics of sustainable prosperity. We can do much better in the future than we have done in the past. We can avoid the kind of bubbles and crashes, or at least we can ensure that our monetary system is more stable in the future than it has been in the past. We can have a lower level of inequality. We can deliver full employment in the sense that we can permanently eliminate involuntary unemployment. We can do this without creating hyperinflation. We can fund better a variety of public services in the future than we have in the past. It is appropriate to run larger fiscal deficits on average in the future than we have done in the past in order to have stronger private sector balance sheets and better regulated financial institutions. We can give most people a better quality of life in the future than in the past, while meeting our ecological and other challenges along the way, if we see the world through a modern monetary theory frame, and if we begin to introduce some of the policies, particularly including the job guarantee, that economists like William Mitchell and Warren Mosler and Randall Wray and Stephanie Kelton have been advocating for many years now.
Great, thanks for that. And I'd love to talk about the sustainability aspect of MMT some other time in the future if you get time.
Absolutely.
Great, brilliant. All right, well, thanks for all your time, Stephen. And, it's really cleared up a lot of things for me, and hopefully it will for the listeners. So
great to talk to you, Christian.
All right, thanks, Stephen. And we'll talk soon.
Yeah, see you.
Thanks, cheers, bye. That was the MMT podcast with Patricia Pino and Christian Riley. You can get in touch with us on Twitter at MMT Podcast, or I'm at Christ Riley, spelled ChristReilly. And Patricia is at Patricia N. Pino, spelled PatriciaNPino. You can also email me at christriley@outlook.com. Thanks for listening, and we hope to hear from you.
Just you trying to edit this conversation to make it not incredibly boring.